Hey guys, welcome to another edition of the Friday Wrap. All right, so we are 5 minutes from June, and for me, a lot of my focus turns to tax planning strategies for my clients, myself, understanding what's available and the benefits that these strategies provide to you to implement them for the benefit of, saving tax or deferring tax. Keeping more money in your pocket, basically. Some of these strategies are created for the intention of stimulating the economy, and the one we're going to talk about today is exactly that. But things that you can do, things that we're going to talk about over the coming weeks, are things like salary sacrificing or increasing payments into super this month, deferring income till July the next financial year, prepaying expenses this year, purchasing assets, and that's what I'm going to talk about today. This week's wrap is all about the instant asset write-off. So I mentioned that this particular strategy is one that's been designed to stimulate the economy, given the coronavirus and everything that's coming along with it at the moment. So I want to talk about how it works, what it's about, and a little sting in the tail, which you'll understand as we go through. So the instant asset write-off. Under this system, an eligible business can write off the cost of an asset that costs less than the threshold. So you can write it off. You can claim the amount as a full deduction. So my second point there, the eligible business can claim a tax deduction for the business portion of the purchase in the year that it's first used or installed ready for use. So the eligible business is a business that is a turnover of less than $500 million, and the asset can be up to $150,000, and it can be multiple assets. And so that's what they're talking about, the instant asset write-off. Now, generally, if we had assets that were above the amount that we can instantly write off, which this has been increased for this year, you'd have a situation where you depreciate the asset over time. Now, that might look something like this. Let's say we had an asset which was, and if you're going to wonder what that acronym means, it's opening written down value. So it's got an opening value. You might have purchased it for $20,000. Now, to make numbers easy, if we were to depreciate the amount by 10%, the depreciation, the deduction that we would get this year is $2,000, which means we've got a closing written down value of $18,000. Now, that closing written down value becomes next year's opening written down value, 10% depreciation into the closing written down value, so on and so forth, and you write off this asset over time. Now, if you sell the asset, how does that work? Well, from an accounting point of view, let's say if you've got a value of $16,200, if you sold it for $15,000, you've sold it for less than what the business said it's worth. So you make a loss on your sale, and it's a deduction in your entity for the purpose of that tax year. If you sold it for $17,500, you've sold it for more than it's worth. You've made a profit, so you add back some money. But what about when you write the amount off immediately? And that's where I talk about the little thorn in the tail. So yes, it's great that this year we can go and purchase an asset and instantly write it off. If you went and bought an asset, say it was this ute for your business and you need it, it's 100% business use, and it cost you $82,500. Let's say, it's not correct, but let's say that GST was $7,500 and you claim back that full amount of $7,500 on the asset that you bought. So you immediately get that money back in your next BAS. From a tax point of view, you claim $75,000 as a deduction against your business's financials that year. Now, if you're trading as a company and your tax rate's 27.5%, that's $20,625 that you're not going to pay. So because you've been able to go out and purchase the asset for $75,000 and get an immediate deduction and not write it off and claim, 10% or what the amount is every year, you immediately get a deduction of $75,000. That saves you $20,000 in tax this year. That's great. It works well for now. You save a lot of money now. But what happens if you sell it? If you sell it in 3 years' time, or if it was that ute that you purchased or whatever it is, and you trade it in on a new one, you're going to make the full amount as income. So if you sold it or traded it, whatever it was, for $38,500, there's $3,500 GST that you've got to pay back to the ATO because you've made that as income. And there's $35,000 that you have to put into your profit and loss as income. So a little thorn in the tail, not massive, but something to be mindful of. Yes, it's great that instantly we can write off this amount. We're going to get a bigger deduction in our business. We're going to stimulate the economy because we're going to go out and buy something that we may not have done otherwise to get a tax deduction for ourselves this year. But just keep in mind, down the track, it might come back and, it might slap you in the face a little bit if you weren't expecting that. So I just want you to be mindful of that, understand how it works. So for the next few weeks, I'm going to talk about tax strategies. Today was more about businesses and how, the businesses can benefit from this one. I wanted to do it today because it gives you a month to go out and find the asset if you do need to purchase something. Next week, we'll talk about utilizing super as an ability to put some extra money in super this year. And then we'll talk about, as I said, prepayments of expenses, delaying income and that sort of thing over the coming weeks. So hope you're getting some value out of these guys. Like I've said earlier, I'm enjoying doing them. Anything you want to hear about, any topics you want covered, let me know. We'll get them done. All right, we'll leave it there. Be good. Chat soon.